Hey everybody, how you doing? It's your buddy here, Uncle Bruce from the YouTube channel Stock Markets with Bruce. This is my channel name. Thank you very much for joining me today. Today's date, so that you can understand what I'm talking about and why I'm talking about what I'm talking about. Today's date is Saturday, March 23rd, 2024. Okay, so if you're watching this a year from now, remember this is Saturday, March 23rd, 2024. However, I want to show you something. I want to show you a couple of trades here, three actually, where you could use $2,000 of your capital to gamble or invest in Nvidia. And that's important to understand. Gamble or invest in Nvidia, where you can make anywhere from a couple of $100 to 900 something dollars on an annual basis. You could make anywhere from about 2,500 to heck, $4,500, $5,000 on the same $2,000, whether you're a gambler or an investor. And I want to give you a little background quickly. First of all, my channel, just so you know, I'm live Monday to Friday when the markets are open, 8:30 in the morning till 10:30 in the morning, 1 hour before the opening, 1 hour into the opening, I'm live. And I'm here to talk to you about how to write options and explain the market in plain English so you understand what the heck is going on and what it means. Okay, but we're here to talk about writing options and making money. Income from your money that's just sitting around doing jack squat. So many of you out there have got $5, $10, $20, $30,000 sitting in I don't know what, and you're getting 1 to 4% a year on it, and it kills me. It's killing you, and you've got to make your money work for you. If you get 100,000, 500,000 and more, and it's not doing anything, this will work for you as well. But I thought I'd do this video today about one particular kind of trade. The last thing I'll mention quickly, I have classes that I offer on my website. If you get your butt over here to stockmarketswithbruce.ca, CA stands for Canada, you'll come to my website. And if you get over there brave enough to click it, you'll find my mug right there. There's my face. And if you click on classes, you'll see this header right here. Attention students, class is in session. And you can then start looking at classes on how you can write options to make money. Whether you own stock or not, or whether you're doing credit spreads, or whether you're going to do poor man covered calls, all the different strategies. Not every single particular one that ever was created in the history of mankind. No. But this will get you through some basics. And I can tell you right now that a number of my viewers have taken these classes and they have quit their day jobs and they now live off of option income premiums because they've learned how to write options. All right. Now, let's talk about three options trades that might interest you. I wanted to bring up a stock that we all know. We've all heard of these guys, a little company known as Nvidia. Now, let's take a look at this chart right here as I put my mug down here in the corner, get rid of the banner there. There I am. Look at that. Look, this is a chart for 1 year for Nvidia, okay? So on the far left, which is like, way over there, that's today, March 23rd. And if you go backwards, you'll see April 2023 at the very far left of the screen. So from left to right, you can see how the shares went from about $250 or so. 258.50 is the 52-week range. If you look at the very far end of the bottom of this little illustration, you'll see 258.50 is the 52-week range for the low, 974 for the high, and you can see this run up that happened in June. There was a shock. Then it meandered along just under the 450, 500 range, 4,500. Then it broke through 500 to 750, and now almost 1,000. Look at that stock. Who hasn't heard of Nvidia? Now let's take a look at some other charts. This one right here, I believe, is a 3-month chart. Okay, here's your last 3 months: January 24, February 24, March 2024. And you can see where the shares were below 600 in that 500 range, all the way up now to this level. And then here is the week chart that we just finished, the week's chart from last Monday to Friday. Look at the stock, how it varied in price. You can see the range just over 850 all the way up to just under 950. This is a typical week now for this stock, okay? Now, with that in mind, knowing that this stock has this kind of what we call volatility, how in God's green earth do you write options on something like this and make money? Now, look, if you want to buy 100 shares of Nvidia as an investor and then write a call option against your 100 shares of Nvidia and bring in a premium that might be a month out, 2 months out, you might write a $50 higher call option and bring in some income. Sure, this is a viable conservative strategy you can use. The catch is there's always a catch. There's always one thing. The one thing you got to understand is in order for you to write a call option on Nvidia, you have to have 100 shares of Nvidia, and you want to buy 100 Nvidia shares right now at $940 ballpark. You got to come up with $94,000 to write one call option. Now, for many investors, can't be done. It's just too darn much money, or they don't want to risk that much of their retirement or capital on hand into a position in this manner. Again, if you're a millionaire, a multimillionaire, you can buy 100 or 500 shares, 1,000 shares, knock yourself out, of course. Well, I want to talk to you about those of you who've got $2,000, $4,000. You got 6, you got 8, you got 10,000, maybe 20,000. This video is for you, but don't despair. If you've got 100 grand and you don't want to buy the stock, you want to utilize some of your 100,000 towards the trade that I'm going to talk to you about, perfect. Here we go. All right. What can you do to make money on Nvidia? And is it gambling or is it investing? Okay. Let's talk about a very conservative way to make money on Nvidia, or at least attempt to make money on Nvidia using what we like to refer to as a put credit spread. What the hell does that mean, you're asking me? Well, if you haven't taken my lessons, shame on you. You know where to go. Start watching number 1 and move all the way up. You'll learn all of what I'm about to tell you in the lessons in plain English, but in the simplest terms possible. If a stock is $940 odd a share, closed at $942 on Friday night, and you believe that the shares are unlikely to drop very far, but likely to go higher anyway in the next month or so, then a put credit spread might be a way to go. And this is where you do 2 transactions at the same time. The good news is that the platforms out there that let you do these trades, they're there to help you do these trades. If you've got your platform trading account set up for options and also for perhaps something known as level 2 trading, you have to check with your broker. They have the help pages. They'll help you with this. Anyway, if you're serious about this, this won't stump you. Easily done. You only have to do it one time and you're on your way to riches, I hope. What you can do is you can sell a put contract against Nvidia and then buy a put contract at the same time with Nvidia. And what happens is that you bring in more money when you sell your contract than what you're paying to buy the contract. It's called a spread. It's a credit spread. In other words, you're bringing in more money in cash than you're spending to buy the other contract. The difference between the two is what we call a spread, and there's a credit involved. Let me show you in plainer English what I'm talking about. Bear with me. Look at this, okay? Don't freak out. This is easy. Once you get it, you get it. At the very top of this chart, right up there, okay, wherever that is up there, Nvidia, the closing price Friday night, $942.89, okay? In this first example, which is the most conservative example I'm going to show you, is where you're going to buy a put contract on Nvidia for $1.55. This is an April 19th expiry. That's a month from now, not even. A $720 put for $1.55. I'm using closing quotes Friday night just to give you an idea. These are approximately within a few pennies of each accurate. You're going to spend $155 to buy a put spread right here for $720. Down here, at the same time, you're selling or writing a $740 put spread, or put contract, excuse me. Same expiry date, April 19th. But it's a $20 difference in price from $720 to $740. You're selling this one and bringing in $200. So you bring in 200 and spend 155, thereby keeping the change, which is $45 or 45 cents, which is $45 a contract. Let me show you this little thing right here. I'm still here. Don't worry about it. You'll note that on the very top of this thingy here, right there, it says, as of March 23rd, 2024, the stock at 942.89. Entry credit, $45. You have $2,000 in cash. You've written one put, bought one put, and you've brought in a $45 net credit. And your risk on this trade is a whopping $1,955. This is how much you're putting on the line. You could lose $1,955. How much can you make? You could make a profit of $45 on this transaction. Again, it's the credit we brought in the first place. That credit at the very top there is the most you can make on this trade. If you go a little lower, it says maximum return on the risk of $1,955 is a 2.3% return. And if you did this for an entire year, every year you did this put credit spread under these circumstances, your net profit would be, or return, 30% a year on your money. Break evens at expiry 739.55. In other words, the stock would have to plummet all the way from $942. That price at the top there, see the price? $942, that's Friday's close. The stock would have to go down to $739 on the very last day of these contracts' existence for you to break even on this deal, to only break even on this deal. Stock would really have to drop $200 a share. The probability of you profiting on this transaction is 96.6%. Why is the profit so high? Why is the probability of this profit so damn good? Well, the stock is $942 a share right now. Even last week, it fluctuated between $860 and $9 whatever. The odds of the stock going all the way back to $740 a share are pretty low, and that's why 96.5% chance of making money. The institutions of the world, the insurance companies of the world, large pension funds, hedge funds, ETFs that are out there that manage billions of dollars for investors, these are the kinds of trades that some of them do. They'll do these kinds of transactions. Very low profit margin per contract, but very low risk level per contract. And so they sleep at night knowing that, you know what, by April 19th, those two contracts, that the 720s and the 740s for April 19th will die without any value, because right now, at this moment in time, with the stock right here at $940 a share, we have two contracts that are $200 out of the money, and they only have until the 19th of April to live. And of course, you know that there's only 5 trading days in every week. These contracts are in trouble. And this is why they're so cheap, $155 and $2. They only have time value, they have no book value. And if the shares stay at over $850 just in the next week and a half, these contracts will be worth 50 cents each. If the stock even goes down to $800 in 3 weeks from now, with a week left to go, these contracts will still be 50 cents each. They are going to go to zero, because over $740 a share for this stock, these contracts are worthless. They will die completely zeros. They will be the zeros, and you'll keep the $45. Now, obviously, what happens Monday morning, Bruce, if this chart keeps doing what it's doing here? Look at this, Bruce. It went from, $850 on Tuesday morning, and it's almost at $950 now. What if the stock goes to $1,000 on Tuesday or Wednesday of this coming week? These contracts will probably lose half their value by the end of the week, because if the stock breaks 1,000, these contracts are out of the money, $260, $280. They're going to go down to 80, 90 cents each. And then they will continue to go to absolute zero. So theoretically, you could say to yourself, okay, I got $2,000. That's all I got. I'm going to write the one put. I'm going to buy the other put. I'm going to take the $45 and I'm going to fold my arms. Bruce tells me all the time on the shows and in the lessons, fold your arms and wait until the 19th of April, Friday the 19th, and let these options die worthless. You don't have to buy them back. You only pay a commission to create the trade. There's no commission on the other side. And the next Monday, after the 19th of April, the 22nd of April, you're going to do another credit spread. And you're going to stay $200 behind the price of the stock, wherever the stock is at that time. If the stock is $1,060, you're going to do $860 puts and $840 puts. Write one, buy one. Bring in probably $45 for a month and fold your arms and do nothing and let those die too. And if you bring in $45 a month, every month, times 12 months, you're bringing in $540 odd on your $2,000. That's 20+% on your money. This is actually pretty good return. I mean, think about it. You can bring in 2.25% on the initial trade. You put up $2,000 and you made 2.25% in a month. Not even, because again, this is not 31 days we're talking about here. 12 times doing that, that's almost 30% on your money. Very conservative, very boring, but predictable. On Nvidia, the hottest stock in the stock market. All right, let's look at trade number 2. You want a little more than that. You're comfortable with the $200 thing, but you'd also be comfortable $100 out of the money. You got a little more. I'm a little more of a risk taker. I want more for my money. Show me something better than that. Well, how about this trade right here? How about this trade? It's the same stock, Nvidia, 942. Here's the same expiry date, April 19th, same expiry. But look at the price of the contracts, all right? How about this contract right here? You want to be a mega gambler? How about writing a $920 put contract and bringing in $37.60? Or paying $37.60, excuse me, you're buying this one. And then you're writing this one here, the 940, and bringing in $4,700. So you're bringing in $4,700, spending $3,700. How about that little trade? That one will look like this. You'll bring in $975 in cash. Your maximum risk against your $2,000 is now $1,025. That's the most you can lose on this trade. Your maximum return, $975. The maximum return on the risk level is 95%. Pretty nice return, putting up $1,025 in risk to bring in $975. Break even $930. The catch, of course, is the profitability. Profit is 54%. Why is it so lousy compared to 96%? Why can I only make a profit of half the? Maybe it's a 50-50 bet here. This is kind of, Bruce, this is kind of scary here. What are you trying to tell me here? Well, let me do this for you. I'll go down here and let me show you again this trade here. Again, this is a 3-month chart of our Nvidia. Just 3 months. Look what it's done in 3 months. From 500 way over here on the January 24, all the way up to 900 something up here on the right. And again, 5 days. We know this last week. Look what the stock has done in the last week. Now, if you're going to play options that are $920 and $940 instead of $740 and $720, you are $200 closer to the market. You're right there. I mean, the market is stock closed at 942 and you're writing a 940. That's a contract right at the money. You deserve risk. You're playing, you're right, standing right beside the fireplace. There might be a spark coming off that log. I might get you. Might hit you in the arm and sting you. You got to be careful about something like that. Or maybe that's a little too risky. The first one's too boring. The second one is too risky. Bruce, for crying out loud, help me out here. I need something that's a little better, but not too stupid. How about this one right here? Is that the one? No, not this one right here. How about this one right here? Yes, this is the one. Okay, Bruce, get over to the side. How about this trade? How about you do a buy an $820 contract, $100 away from the market, and you write the 840. So you write the 840, 100 below the market. You bring in $1,155. You buy the 820, which will cost you $835. And on this trade, you get a credit of $320. not $45, not 900 and something dollars. You bring in 320. Your maximum risk is $1,680. Your maximum return on your risk is $320, or maximum return 320. Your return is 19% or 248% a year. Could you live with something like that? Your probability of profit is 81.5%. Maybe this is the trade for you. They all expire April the 19th, less than a month from now. They're either at the money, 100 out of the money, or 200 out of the money. The probability of success is 54%, 81, or 96. What do you like? What are your thoughts on that? All of the trades, you require $2,000 up front to make a trade, to do the trade, and then you get the credit right away. $45, 300 something, or 900 something. That's in your account. You sit on that money, and you will either do nothing, and let the stock do what it does, and you cross your fingers. And scenario number one, the stock doesn't go down $200. Scenario number two, the stock stays at 940 or higher. Or scenario number three, the stock stays at 820 or higher, and you win in all three cases. Which one fits your style and risk tolerance level? Now, think about it this way. I told you at the beginning of this video, if you want to buy 100 shares of Nvidia, it's $94,000. With $2,000, you can do a trade on Nvidia options, credit spread. You got $20,000, you can do 10 of each of these. So you would bring in $450 instead of $45. You bring in $450. You could bring in $3,000 plus, or you could bring in $9,700, depending on how many of these you want to write and what kind of risk tolerance you have. If you're a riverboat gambler, you're going to go, oh yeah, baby, let's go. I'm doing the April 19th, 920, 940s, because I'm an idiot, because I wouldn't recommend you do that. If you want to be around a while and you want to return some nice returns on your bottom line, you're going to do the 800s. You're going to bring in 3,000 plus bucks for less than a month of your time. And if you can do this 12 times a year, every year, or 12 times a year, you bring in 3,000 something dollars, 12 times 3,000, that's 36,000 bucks. If that's inside your 401k, or if that's in your personal trading account, you're adding $36,000. You're trying to quit your day job, you need at least $5,000 a month to live on. You're going to have to do 20 of these, maybe, or 18 of them. But if you did 20 of these spreads at $3,100 credit per, $6,200 per month would be the credit coming in. And if you let them expire worthless, you keep that money. Now, in all the examples I've given you, every single one, there are ways to roll these contracts. There are ways to close this out early. There are ways to say, you know what, Bruce, I got 80% of the profit here on this trade. I'm going to close this out, and I just want to turn around right now, create a new one that has a month to go right now. I don't want to wait the last week because I've got 80% in the bag right in my hand. It's going to shut this one down, keep the 80% of the money, give 20% of the credit back, turn right around, create a new credit spread, good for a month from now, bring in another $3,000 or $450 or whatever ones you're writing. You can also roll them anytime. If the markets do go down, the stock does back off, you can forward roll these contracts further out in time and lower their strike prices. So as the shares come down, your two contracts go down and you can stay ahead of the market. You'll go further out in time to complete the win, but you will get a win when it's all said and done. All of this, everything I've just told you, in 24 short minutes is available to learn if you're serious about making money in this business from a lot of my classes. You have to go to my website. stockmarketswithbruce.ca is where you got to go. Check it out. Take class number 1. They're $150 a class. You can watch them as many times as you want. There are no quizzes. There's no tests. It's all in plain English. And I'll show you with each class that piles more information onto the next one and the next one and the next one. You'll understand the whole picture of options so that you have a clear understanding of what options are, how they work, how they go up in value, down in value, how they expire, how to write them, how to buy them back, how to create spreads, how to do covered calls, poor man covered calls, cash secured puts, and everything else. To the point where you'll realize, geez, after a couple of these classes, 3-4 classes, I'm already writing options. Like, I'm already doing this while I'm taking the classes. I'm making more money from writing options than it costs me to do the classes. That's the point. Earn while you learn. This is your at-home college class with the professor right here, and you can join me every day, Monday to Friday, live. 1 hour before the market opens, 1 hour after the opening, I'm here, and I'll be talking about actual trades. And you will read in the comment section that goes whizzing along from my students I've been doing this with now for 3+ years on their existing trades and what they're doing. And they're telling us, hey, I just closed this position, or I just created a new position. And as you take the classes, you'll go, I know what that means. I know what he's saying. It's not foreign to me anymore. Are these fancy option words? I now know what they mean. Bruce's classes. Up to you. Decide if you're serious about making money in this market. If you're doing what I just talked to you about doing, writing $200 out of the money Nvidia put credit spreads, $100 out of the money, you are the casino. You are the casino that owns slot machines that gamblers are playing. And gamblers lose, casinos win. And I want to turn you into a casino. Thank you for joining me today. If you've lasted this long, you're on your way. You're serious about understanding how this works. Thank you again. See you Monday to Friday, 8:30 to 10:30 in the morning, Eastern time. Let's make some dinero. Have a great day, everybody. We'll see you next time. Bye for now.